Folks, how you doing? Coming through loud and clear, I hope. Awesome, awesome. So we nibbled a bit from the short side yesterday. Fine. That was nice. Guess what? Millions of people out there are bearing the brunt of this. Not one single financial advisor or money management outfit or shop, whatever they call themselves, predicted this. So we're in good shape right here, and we are going to stand on the sidelines until it's time for the mother of all reflex rallies. Okay? Let's see what's happened so far. First of all, the transports. They're now trading at 2016 levels. Okay? And that's where the support is, having breached the not just the support line, but also every extreme associated with this bullish shark. And I was expecting it kind of, because down here it's more or less no man's land. You have to come back down to, you have to reset the clock, okay? And where do you go back to? Where this whole leg started, the inception point of it. So, somewhere inside this, let me bring up a marker here. Somewhere inside this congestion zone, right here. And that's where we are right now, inside this congestion zone. Where does it end? We'll have to basically rely on the benchmark index, which I'm going to discuss here in a minute, to figure out what the market is trying to reprice. What the market is trying to reprice. So this is the transports. Let's look at the bank index, the NASDAQ bank index, which is what I use to gauge the conditions of the financial market. I don't look at XLF or the whatever else ETF. This index has served me extremely well over the years. Where are we at? Right here. Okay? So we are within striking distance. We're almost there as far as this is concerned, maybe 50 points lower before we reach the most notable swing low right here, February 2016. And maybe, just maybe, this will catalyze a rally. But again, not all these indices move in concert with each other. We know, for example, the transports and the bank index, they all started their journey down well ahead of the other indices. And of course, they don't contain all the beloved names, the mega caps, which are the names that have sort of held the S&P and the NASDAQ above the levels that we had been expecting for weeks. So that's the bank. I will discuss the S&P here in a minute, but look where it is right here. It is within striking distance of what the late December 2018 lows. All right. And I think this is going to go on for a while, and until we get down here somewhere, we will not bounce back in a sustainable fashion. So there'll be some profit taking from the short side. Short covering is what I meant, but if you're a bear, it would be a profit taker. I think you might see one tomorrow, which would set the stage for another bout of selling. And I would expect that one to bring maybe this phase of this bear market to an end. because at some point you have to price in everything. Everything is priced in at some point, and once the economic data starts to show what the market has been pricing in, what else are you going to price in? You see, it might be another retest of the lows, marginal breach of them, and you start, forming a base from where you could possibly ignite or catalyze a counter trend rally, multi-day, sustainable, maybe multi-week. Let's look at the SOX. The SOX is finally, if you look at it, finally at the last June's lows, actually, right here. See that? Last June 2019 low. And if you recall, see if I can bring up a line here. If you recall, and most people don't see it, there was actually a triangle. The whole B wave is a triangle like this. That's the triangle. So we're down to the June lows. I think this would probably go on to test the red line, and if things really get worse, we might go further down. Okay, but right now I'm eyeing the red line, the rim. This is the 2000 highs 20 years ago. And this area right here, you could think of it, let me bring up a rectangle. You could think of, you can think of this area right here as a support area from where a bounce could develop. Actually, I should actually extend it further, or this is your support area. Should this area right here, the June 2019 low, should it be breached at some point, we're probably headed down to 1100, the bottom of the fourth wave. We'll see how it goes, all right? Now, this was the SOX index, NASDAQ composite. My interview last week with Dale Pinkert of Forex Analytics, I said, watch this zone, 7,000, 7,600. That's the previous bearish crab potential reversal zone. And I think if this continues on down, I'm going to say another, 7,300 to roughly 7,100. We're talking about 2.5%. 2.5% more downside. And I believe you're going to see that. And from that level that's where I would start looking for a bounce, a rally. Okay, this right here is the June 2019 low. So we're here, even though many other indices have far exceeded this level to the downside. Finally, the NASDAQ and the S&P are following suit. The Dow Jones, it is below the, the December 2018 level. It's below it. Okay, where is support? That channel. The channel right here is support. So it's currently trading at 21.4. 21.4 within striking distance, couple of percentage points as well, couple of percentage points, kind of like the NASDAQ composite. So we want to be on the lookout for another 2% downside before looking at the possibility of the start of the reversal. Or maybe that reversal will begin with a bounce and then a retest of the lows, maybe a marginal breach of those lows, and then we'll go on. Believe it or not, I'm looking for last week's highs, 3,000, 3130, that area to be revisited as far-fetched as it seems at this very moment. Let's look at the Russell 2000. Wow. Check this out. Now, again, the Russell will probably be more in line with the bank index because it does contain a lot of financial institutions than the S&P or the NASDAQ, of course. So I would have expected it to trade more or less in concert with the bank index, the NASDAQ bank index, kind of the same pattern. Now, if this was the first leg down, here's the thing, and I don't know what the market is looking at. I don't know if this was the fifth wave or not. I believe it was a failure in the fifth wave. But the market is probably going to look for an ABC anyways. A, B, and a C. And guess where that ABC relationship reaches the 1.618 multiple, or extension if you want to call it. So I'm going to throw out on the chart a couple of fib extensions. Not that I care unless it lines up with something very significant. So first of all, the dashed red line has been broken, and the 161.8 extension, should we get there at some point, would be in line with the February 2016 lows. Are we going to get there? We'll find out soon. So right now we're within, again, a couple of percentage points of a respite place. Again, don't have a crystal ball to tell you if we're going to stop right here or not at 1100, 1110. But if the other indices are within 2.5% of a potential bounce, so will this guy, because it is more oversold than any of the others. For example, at the height right here, I'm going to bring up my calculator here. At the height, or let's take it from this here, from the January high. 1715 was the high, and as of today we are at 1133. So let's subtract 1133. We're down 582 points. Divide that by 1715, and in percentage terms, it's down 34%. Okay, Russell is down 34%. And I found it really funny that Goldman Sachs, Costin, yesterday said that the bull market is about to be over. In other words, he's expecting 3,400 by end of year, and then the bear market starts. Well, if that's not a bear market, I don't know what is. However, I do have some thoughts I'm going to share with you in a minute about that. So that's the Russell. I'm going to talk about the SPX when I bring up the futures chart. What I do want to show you is if you look at SHYG, check this out. Remember this chart? This is corporate bonds. If corporate bonds crash like this, what happens to the yield? In other words, if companies are going to sell bonds to raise money, if bonds get this cheap, their yields go high. So I really, as a corporation, as a company, if I'm going to sell bonds, I'm now forced to pay a high yield. What does that mean? It means that for corporations at this point, it's becoming very hard to borrow money, to raise money. Now, in 2018, remember what I said about that being the rejection zone? Why is that? Technically speaking, we had this big green candle in February, and anything below it was a rejection zone. When we tested that rejection zone, or the upper boundary of this rejection zone in December, I said, you know what? The correction probably ended. Okay? and then we bounce back, and now look where we are. This is not looking good at all for companies who are looking to raise money to keep operating. So that's for SHYG. Other than that, I'm going to actually switch over to the other charts, starting with the ES. And then I'm going to talk about valuation. And then after that, maybe I'll look at some names that you're interested in, Microsoft, Apple, so on and so forth. Look, let's compare what's happened here recently to what happened back in 2018. In 2018, that here was the value area high, about 2820, let's call it. Value area low, about 2620 or so. And the volume point of control at about 2720. So we know, looking back, that we had a head and shoulders. And the right shoulder, what happened to the when the right shoulder formed? First of all, price declined starting in October 2018 in zigzag form down to the bottom of the value area low, and that was about 2600 and some change, 2616, 2620. Let me see, 2627 was the 2603. And so it bounced back in sideways fashion towards the value area high. And remember, based on my valuation model, it actually came down to fair value after being overvalued. The S&P is, or was overvalued up here, came down, reverted to the mean, meaning at that point it was fairly valued, not undervalued, not overvalued. Bounced back, and finally, due to that misstep by the Fed, the market took a dip down, got down to about 11-12% undervaluation. The market bet rightly that the Fed is going to roll back some of these hikes and start to loosen rates again, cut rates again, and that's exactly, they bet correctly on that. So here, we got down to fair value based on my valuation model. It was about 2760 to 2720. That we got here, we bounced back. Everybody thought, hey, there are some reversal signs here. And I said, no, it's an optical illusion, if you recall, because I knew what was happening under the hood. And now we're down to where? As of today, what was the low? 2492. Now, what does that mean? We got down below what was fair value back in 2018, and now we're inside the 2017 value area. So, should have labeled that, put it right here for you. That's the 2017 value area high, about 2550. Value area low, about 23 and change. And volume point of control 2362. So look here what happened. In 2018, what did we do? We went all the way down to 2017 valuations. We hit the value area low, and what do you think is happening right now? We're rolling back, or we're basically repricing all these assumptions that we've started doing since the bottom of 2018. So right now we're kind of like in no man's land, technically speaking. I don't see this stopping until we reach, first of all, 2444 will probably be the level from where we could bounce. But I think what's going to happen for this C wave, because remember, we have an ABC here in progress. I need a marker. Color, I'll use, I don't know, magenta. And what we have here is an A, a B, and a C. So I don't see it stopping until here. Maybe we'll get a little bounce, and then the fifth wave of the C wave will come down towards the bottom, the 2018, late 2018 bottom, maybe a little lower, and that would be more or less technical. It'll be where wave C would equal 161.8% the size of wave A. So I'm expecting this to end within, where are we right now? About 25.33 is where we're trading. So another what? Down to 22.56. What are we talking about? 250 points, 200 points, something like that. I think I'm trying to do the math. So 223. Yeah, about 250 points, roughly speaking. Okay. So, blood's in the street, it never changes. That's human nature at work right here. Fear and greed. We were annoyingly greedy just a few weeks ago, and now the exact opposite is happening. The exact opposite is happening. All right. I don't know if this ABC is going to end this correction. I don't know. Are we to expect a V-shaped recovery? I very much doubt it, okay? Because this virus is going to have a lot of lingering effects. It's going to have a lingering impact on economic growth. How soon will we recover from it? I don't know. Here's the other thing I'm thinking about, okay, because of what Costin said yesterday. We have the first ABC, and upon the completion of the ABC, you're going to have one heck of a rally taking you back towards the zone of wave B. What's wave B? 31.33 to 28.85. We're going to be here somewhere. All right. So assuming that we're going to bounce back, we're going to have a mean reversion move. In my opinion, forget Fibonacci levels and moving average, whatever. The only moving average in such a situation that would work is the 200. And the 200 currently is more or less in line with last year's value area high, which is 30.30. That's the top of the triangle. If we do exceed that 30.30, we're going to go up to here somewhere, 3,100. So I think a bounce will take us back up here. Okay? And they do want to rally the market into the election, I'm pretty sure. That's the only thing I bet that's on the administration's mind, is to get this thing under control as quickly as possible in order to be in a good position for the election. If we get all the way down here to 60 to 22.56, a 61.8% retracement, these retracements are not going to mean much to me. I'm going to look for the actual relevant things on the chart, not a retracement. Okay? So forget Fibonacci right here. On the way up, we're going to recover to whatever the 2020 full year earnings estimates will end up being. That's what I think, in my opinion, right? At least back to that, that 30-30 level, the top of the triangle, maybe higher. Now, that Costin guy, the Goldman Sachs guy, you cannot really dismiss what he's saying. Okay, he's not a fool. So I'm thinking that if this bear market has a lot more to go down the road, okay, we know from the Elliott wave theory that corrective patterns come in all sizes and shapes. You got an ABC is one possibility. You also have an A, B, C, and followed by an X, and then maybe a 1 1, 2, 3, 4, 5. That would be a flat formation. You could have a triangle. You could have all sorts of patterns, okay? So let's say that the scenario is one that gets us back to the highs. We start with an ABC to the downside. We have another ABC to the upside, and everybody's saying, oh, V-shaped recovery. And then suddenly, Trump loses the election, and you start getting that 1, 2, 3, 4, 5. See what I'm saying? So this could be a flat formation. And believe it or not, so I said 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. In a flat, it's possible for the counter trend rally to actually exceed the prior high. And that will fool everybody into thinking that, hey, we're breaking out again. We're not. And then it comes back down in the most unexpected fashion to retest the lows, maybe exceed them slightly. We have no idea. Okay, that's total prognostication. All I'm telling you right now is that I have enough clarity, reasonably so, to predict an end to this current leg down somewhere inside this blue or turquoise zone. All right? Anybody tells you otherwise, they're lying to you. Or anyone who tells you that they have more visibility, they're not being honest, in my opinion. So if we look at the NQ for a second, the NQ, the NASDAQ 100 futures, finally, we've been waiting forever. We, again, and let me bring up the case one, I think, yeah, here we go. I said, we're up here. There's no way we're not going to get down. Retrace the entire triangle, and later on, maybe down to here. Okay? It's possible. All right? So right now, I'm going to be an optimist. I'm going to say, you know what? This thing right now is at 7,400. I'm going to wait for it to come all the way down to 7,000. So again, not all the indices are going to decline by the same amount. One can go down 2.5%, the other one 3.5%, so on and so forth. But, technically speaking, I think the NASDAQ won't relent until you hit the bottom of the value area for 2019. See, that was 19 or 18. Yeah, that was 2019. So right here, which is the June bottom, more or less. Okay, that's exactly where I expect the NASDAQ to finally take a respite. And while this is happening, watch for Apple to reach what? I would say at least the 200-day moving average around 245. Personally, I'd like to see it test the level that it has struggled with in the past, 234. So low 230s. Maybe if the stuff hits the fan, you'll come down to that 222 level that we saw last summer. The height of last summer's or the high that was reached last July or early August 2019, 222, before it took a hit all the way down to 190. But I personally think it will probably stabilize near 232, 234, something like that. So again, watch Apple in relation to the NASDAQ futures approaching the 7,000 mark. All right, from a valuation standpoint, I'm going to bring up my spreadsheet for a second. Here's the spreadsheet, and as of yesterday, I'm looking here at the valuations since 2018. We hit lofty valuations here in January, February, and then we sold down. As of yesterday, we were, I don't know how updated this is, but let me put it this way. I'll give you a better idea, or maybe I can do it right here. So 3.9, here we go. 3.11, yesterday we closed at 27.41. So I'm just gonna add another row, even though I don't know what the close will be here today. What are we trading at right now? The ES is trading at about 2,500. So I'll update the numbers later on with actual data, but I'm gonna put in 2,500 here for high, low, and close. Okay, because 2,500 relative to fair value puts us at, guess what? 8% undervaluation. In other words, if this COVID-19 virus disappears today and activity resumes, economic activity resumes, the market will snap back by 8% in a heartbeat to go back to fair value. And that makes sense because we are down today 8% from fair value, which was yesterday's level. So now, here's the thing, is 8% enough? I don't think so, because back in late December 2018, there was no COVID-19 virus. There's nothing crippling economic activity. The market was just upset with the Fed, and there was signs of a global slowdown, but nothing like what we're talking about right here. So guess what? We got down to here. All right? We got down to here. So today we're probably going to be down here as well. And we'll see if that's going to get even worse down the road. We don't know yet. We'll find out sooner or later. In fact, I'm going to show you exactly what the chart would look like by the end of the day, should we close around 2,500, let's say. So I'm going to add another row to this chart. And look where we'll be by the end of the day from a valuation perspective. So any bit of good news in the coming days and weeks will easily cause or catalyze a short covering rally back to what? Fair value. Fair value. But we need some real, actionable news or data or steps from whether it's fiscal policy. We already have monetary policy. We have more monetary policy coming. But now we're looking for fiscal policy, meaning what is fiscal versus monetary? The Fed controls monetary policy. They have a mandate. They have a mandate. They cut rates. They play with the monetary knobs. Now, on the fiscal side of things, fiscal policy is in the hands of lawmakers. They can, say, create or put together a stimulus package entailing a number of incentives. For example, you heard the president a couple of days ago proposing payroll tax relief, and I'm sure they're working on a more comprehensive package that also entails monetary or financial aids or measures that would make it easier on those companies most likely to be impacted by this coronavirus to continue to operate. So again, as of today, we're going to be oversold or undervalued by 8-9%. And I think this could go on. You might see 12-15% undervaluation. All right? All good? You guys are hearing me, right? All righty. So I'm going to go ahead and end this, and then I'm going to post it in about an hour or so, in about an hour.